25 basis points has been cut. I wonder what kind of difference that's going to make to the everyday Canadian. The Bank of Canada this morning cut its benchmark interest rate for the second time in a row, taking it down to 4.5% from the previous 4.75%. And this is a move that was very widely anticipated. Pretty much everybody expected this to happen, and it does signal a continuation of that shift in the bank's monetary policy. It's now emphasizing more downside risk to economic growth over the concerns of a potential inflation rebound. Governor Tiff Macklem, he stated that with inflation now nearing the 2% target, the focus must balance the risks of both higher and lower than expected inflation. He also kept the door open for future rate cuts. He said, if inflation continues to ease broadly in line with our forecast, it is reasonable to expect further cuts in our policy interest rate. Now, the central bank's updated forecast, it predicts that inflation will stabilize around 2% next year. And that, of course, follows that peak of 8.1% that we saw back a couple of years ago in 2022. The new rate cut, that's part of a broader easing cycle that began after a series of 10 rate hikes in 2022 and 2023, aimed obviously at combating the severe inflation issues that we were dealing with at the time. So the economic landscape, it has since changed, and price pressures are definitely easing. We have improved global supply chains, restrained consumer spending. We've seen that recently. There are still some lingering inflation in areas. We're talking about rent, mortgage costs. Those are still high. But the overall trend suggests that we're seeing a gradual decline in inflation. That said, the bank does say it will remain cautious. It acknowledges the potential geopolitical and trade disruptions that could reignite inflationary pressures. We don't want to go there. Now, Canada's economy, it has managed to avoid at least an official recession at this point, and it looks like we may be seeing, sort of what's called a soft landing. We've seen GDP growth being positive, driven in large part by rapidly increasing population. Although, as I reported recently, the per capita GDP has actually declined over the past 18 months. The bank's latest monetary policy report, it attributes weaker than expected growth in the first half of the year due to increased demand for vehicles, travel, and discretionary goods. That said, it does anticipate that economic growth will pick up in the latter half of the year, continue through 2025, supported by stronger exports, household spending recovery, and what they're calling robust residential investments. So we'll see how that turns out. Obviously, at this point with this rate cut, we talk about homeowners with variable rate mortgages. Most likely we'll see very soon will benefit from the rate cut, although those who have fixed rate mortgages might see less of an immediate relief. Overall, housing affordability, well, that certainly remains tight, and I think it probably will remain there until we see some more significant rate reductions. The July 2024 survey by the MNP Consumer Debt Index, it shows that the Bank of Canada's May interest cut did fairly little to alleviate Canadians' concerns about their financial situations. The index dropped 6 points and now sits at 85, which indicates increasingly negative perceptions of personal debt. The survey found that 2/3 of respondents desperately need further rate reductions, with more than half of them worried that they will not fall quickly enough to provide what they determine as necessary financial relief. The Bank of Canada had lowered interest rates by 1/4 percentage point in June, and as I just talked about, they've just cut it another 25 basis points this morning. Despite this, though, the survey showed that 46% of Canadians are just $200 or less away from failing to meet financial obligations, and 30% already struggle to cover their bills and debt payments. And this financial strain is made only worse by the high costs of daily necessities, which have not decreased significantly despite these rate cuts that we've seen recently. Grant Basie, and he's the president of MNP, and he emphasized that a lot of Canadians may not have seen substantial reductions in their monthly expenses that they need to reduce these financial burdens. And he says, with the prices of many daily necessities still high, many have not seen the meaningful reduction in their monthly expenses needed to ease their financial burdens. And sadly, this new reporting serves as a stark reminder of the ongoing financial challenges that so many Canadians are facing and the urgent need for solutions that can provide meaningful relief. Are you looking for a balanced investment solution that can offer both cash flow and potential growth? Well, consider the BMO Balanced ETF. That's a fund that invests in a diversified portfolio of global equity and fixed income ETFs. The BMO Balanced ETFs adjust its asset allocation quarterly to maintain the optimal exposure to the different market segments. So whether you're looking for broad market exposure, whether you're looking for low cost diversification or professional management, the BMO Balanced ETF can help you achieve your financial goals. Learn more about the BMO Balanced ETF today to see how it can fit into your portfolio. Visit bmoetfs.com today and find out more. It looks like Canada's grocery industry is finally set to undergo some changes with the introduction of the new Grocery Code of Conduct, which now has gained the support of all of the major grocery retailers. The code has been developed over several years. It's meant to address long-standing tensions between the retailers and the suppliers. And particularly, there's an emphasis on concerning the fees that are charged by the retailers. And these fees have often been a source of conflict as they are demanded to keep products in stock and to promote them. Mike von Massow, he is a food economist at the University of Guelph, and he notes that the retailers' market power has allowed them to impose such conditions on the suppliers, which has affected the suppliers' ability to operate freely. He says, they can say to suppliers, we control 15, 20, 30% of the Canadian market. If you want to access those consumers, you have to give us cheaper prices. You have to pay us to be on the shelves. You have to pay other fees as we established online grocery shopping. You have to accept 90-day payment or whatever. So the retailers have exercised that power. The push for this code, it began after a 2021 federal report that showed the growing scale of these fees, and it highlighted the strained supply chain relationships, discouraged investment from a lot of food processors. The report indicated that smaller producers, independent retailers found it very challenging to compete in the market. The proposed code, it aims to foster fair and ethical dealings, commercial agreements, and the management of the delisting process of products. It also sets out clear rules regarding fees and provides a dispute resolution process, which is expected to protect suppliers and the smaller retailers who lack the bargaining power of the bigger grocery store retailers. So it's great that we finally have seen some positive reception from the industry players. The impact on consumers still remains uncertain. Important to note that the code doesn't aim to reduce grocery prices directly, but Gary Sands of the Canadian Federation of Independent Grocers, he believes that ultimately it will benefit customers. He says the code is expected to help smaller grocers compete more effectively with the larger chains, and that will ensure that essential products are remaining available in the rural and remote communities where independent stores often operate. He says, as a result, some of those communities have been without essential products. With the code, that's one of the principles that we've addressed. That scenario, those types of situations won't occur again. Now, the enforcement of the code initially will be voluntary, and that's a decision that's driven by the complexity of Canada's legal landscape. There were concerns raised about the possibility of different versions of the code emerging across the different provinces if it were in fact legislated. There is an adjudicator who will be appointed to intervene in disputes. The code will be reviewed after a year to assess its effectiveness. The Grocery Code of Conduct is set to come into effect on June 1st of 2025. It will require significant efforts to recruit and brief thousands of manufacturers, suppliers, and retailers in the interim. Shares of Visa were down around 4% out of the gate this morning as the company reported its third quarter financial results, which included a rare top-line miss. Even though Visa reported a 12% increase in earnings to $2.42 a share, which matched the estimates, and also a 10% rise in revenue to $8.9 billion, the results still fell short of expectations. This led several analysts to trim their target prices for Visa. Analysts for firms such as Jefferies and Morgan Stanley, they adjusted their price targets downward, and they cited the missed revenue expectations and slowing trends that they observed in July. Now, while they are still maintaining overweight ratings on Visa's share, these analysts expressed a caution regarding near-term catalysts for positive narrative changes. Jefferies, for example, reduced the target to $300 from $325, and they highlighted the absence of any immediate drivers for growth as cross-border volume growth slows. Visa's guidance for the fourth quarter projects low double-digit revenue growth and high single-digit operating expense growth, with expected earnings per share in the upper end of the low double-digit growth. For the full year, Visa anticipates earnings growth in the low teens, with revenue growth in the low double digits. Despite the tempered outlook they have, Visa's management reassured investors by pointing to stable trends for the third quarter. They forecasted a recovery in household spending and business investment. So the market reaction to Visa's results also impacted shares of American Express, MasterCard, which also saw slight declines this morning. Before you sign off, if you are not a subscriber to our Pulse newsletter, I will put a link in the description of this video here. As always, I thank you for watching, and we'll see you in the next video.